Tax considerations for investors. Because tax strategy often figures into investment decisions, the real estate professional must know about taxation of investment and rental properties. A basic understanding of these tax considerations is important so that the real estate professional can alert investor clients to potential tax implications and recommend they seek the guidance of a tax expert. IRS income classifications and material participation in the most basic sense, how taxpayers generate the income they receive each year and how much they participate in making it impacts the way that income is ultimately reported and taxed. The IRS classifies income in three categories. Active. Earned income and losses from salaries, wages, tips, commissions, and other trade or business activities in which a taxpayer materially participates. Passive. Income from investments in which the taxpayer does not materially participate in managing. Passive activity losses can only be used to offset passive activity income. Portfolio. Income and losses from interest, dividends, capital gains, and royalties. In most cases, income received from a rental or investment property is considered passive income. However, the extent to which an investor participates in the management and operation of the rental or investment property determines the deductions and losses that may be claimed and against which source of income. Participation, passive, active, or material? Therefore, the IRS characterizes participation in the management and operation of an investment or rental property as passive, active, or material. Passive activity. The taxpayer does not materially participate in the management and operation of the property. Income from passive activity is termed passive income. Deductions or losses for passive activity may offset only passive income. If expenses exceed rental income, resulting in a loss, deductions are limited to the amount invested, the amount at risk. Active participation. The taxpayer owns at least a 10% interest in the investment, has an adjusted gross income, AGI, of less than $150,000, and actively participates in management decisions such as approving new tenants, hiring non-independent contractor employees, determining rental terms, and approving expenditures. Active participation allows deductions for losses against other income of up to $25,000. Material participation. Substantive involvement in operations on a regular and continuous basis. Income from activities in which the taxpayer materially participates is considered active, or earned, income. Material participants are allowed to offset deductions and losses from rental property activities against other earnings including ordinary income. Loss and at-risk limits do not apply. Real estate professionals are material participants. Qualifying real estate professionals who own rental property have an advantage because the IRS views them as material participants. In order to qualify, the individual must meet both of the following criteria. More than half of the taxpayer's personal services are performed in real property businesses. More than 750 hours a year are spent in real property businesses in which the taxpayer materially participates. If a joint return is filed, one of the spouses must meet both criteria. The distinction is important because it determines the limits of tax-deductible losses and expenses, income tax deductions. To determine a taxpayer's amount of taxable income, the tax code specifies which deductions are allowable, including operating expenses. Tax laws provide for deductions for all expenses related to the production of income, including operating expenses. For investors who receive rental income, these expenses may include mortgage interest, property tax, operating expenses, depreciation, and repairs. You may also deduct the ordinary and necessary expenses for managing, conserving, and maintaining your rental property, such as interest, taxes, advertising, maintenance, utilities, and insurance. Mortgage interest. Current IRS regulations permit deduction of mortgage interest paid on combined mortgage debt of up to $750,000 for couples filing jointly, $375,000 for couples filing separately, and single taxpayers for a primary residence and one additional residence. Only the interest portion of the annual debt service may be deducted to calculate taxable income. Mortgage interest on a rental or investment property may be deducted as an expense. A property that is rented out can qualify as a second home for the mortgage interest deduction as long as the rental doesn't exceed 14 days. Cost recovery. Depreciation. Depreciation is an annual income tax deduction that allows you to recover the cost of certain property over the time you use the property. It is an allowance for the wear and tear, deterioration, or obsolescence of the property. This includes deduction for the diminishing economic life of the building, fixtures, furnishings, landscaping, yard improvements, and mechanical systems. The components of a real property are categorized, and each depreciated on a separate schedule. Land is never depreciated. When a depreciated property is sold, the amount of tax benefit that has accumulated over the years of ownership is calculated. This is referred to as depreciation recapture, and it is taxed at a flat rate of 25%. This is in addition to capital gains tax. Consult a tax professional. Practitioners should encourage clients and customers to consult with a tax professional on these matters. Categorizing property components, setting up a depreciation schedule, calculating yearly cost recovery deductions, etc. are all rather complex processes with numerous exceptions and nuances in the tax code. 90-day limit on home acquisition debt. Some buyers might decide to finance the purchase of a second home using cash or a home equity loan and then refinance at a later date with a regular mortgage. If your buyer has this strategy in mind, make them aware of IRS provisions regarding a 90-day time limit on home acquisition debt when purchasing property and securing a mortgage against the principal for the first or second home. In order for the mortgage interest to be treated as deductible interest on home acquisition debt, the mortgage must be obtained within 90 days of the home purchase. The IRS regards home acquisition debt obtained more than 90 days after the home purchase as a home equity loan. Interest on a home equity loan secured by a primary home is not deductible for purchase of a second home. Buyers considering this strategy should consult with a tax expert to plan for maintaining mortgage interest deductibility. The 14-day rental rule. The IRS rule for determining whether a vacation home is a personal residence or a rental property is commonly referred to as the 14-day rental rule. Buyers who plan to rent a vacation home part of the time and claim tax deductions for expenses need to know the application of this IRS rule. A compliance strategy should be incorporated into expectations for the property from both the financial and personal enjoyment standpoint. If the property is owner-occupied part-time and rented for 14 days or less in a year, the owner is not required to report the rental income on a tax return. No tax deductions can be claimed for the property's expenses or upkeep if no income is reported from it. A tax-free windfall? Owners of beach and ski resort properties or homes in seasonably desirable locations can reap a tax-free windfall by renting their properties for up to 7 weekends or a short length of time. Daily rentals for these highly desirable properties and time frames can easily run several $100s a day. The IRS does not set any limit on the dollar amount of rental income, only on the number of days a property can be rented before it becomes a taxable event. Think about seasons, sporting events, festivals, etc. that your market is known for. What brings a large number of visitors to town for short periods of time? Brainstorm. Local use of 14-day rule. How could vacation and second homeowners in your area make use of the 14-day rental rule? Think about seasons, sporting events, festivals, etc. that your market is known for. What brings a large number of visitors to town for short periods of time? Do you think your sphere of influence knows about this rule or would benefit from knowing about it? Think of ways to use this information in your marketing efforts. Rented more than 14 days? If a property is rented for more than 14 days, all rental income must be reported, but deductions for expenses as well as cost recovery, depreciation, may offset income. If the property is owner-occupied for more than 14 days or 10% of the time it was rented, whichever is greater, deductible expenses must be allocated between rental and personal use time. Vacation homeowners should work with a tax professional to prorate expenses. The right pattern of usage depends on factors such as the owner's vacation schedule, how much can be made by renting the unit to others, and how much can be realized on a net basis after expenses. The 14-day limit is per property, not per owner. All of the time that co-owners occupy the property counts toward the 14-day limit. Other uses that count toward the 14-day limit include any day the property is occupied by a family member, rented at less than fair market rent, donated for charitable use, rented by an individual who paid a fair market rent but allowed the owner to occupy it without a refund, swapped with another owner even if both pay a fair market rent. Time the owner spends making repairs to the property does not count toward the 14 days of personal use. However, some tax professionals recommend that the owner never occupy the property for maintenance or repair purposes because it can be difficult to document the extent and purpose of owner occupancy. The most cautious approach is for the owner to stay in a hotel. If the owner never occupies a second home and rents it year-round, the IRS will regard it as a rental property. If the property is neither rented nor owner-occupied, it is regarded as an investment property. Capital gains. When an investor sells a capital asset and makes a profit, this profit is considered capital gains and is subject to tax. Capital assets include investments such as real estate, stocks, bonds, cryptocurrency, and tangible items like cars and boats. Capital gains tax is calculated based on the time you've owned an asset, your income, and your tax filing status. Individuals with high incomes as well as a significant amount of capital gains from investment, interest, and dividend income may be subject to the net investment income tax, a 3.8% surtax. Capital gains from the sale of a primary residence is typically excluded from taxable income, provided that the owner has lived in the home for a minimum of 2 out of the past 5 years and their profit from the sale is less than $250,000, $500,000 for married filing jointly returns. However, when it comes to second homes, capital gains tax liability can vary based on whether your home was a vacation property or a rental property. A second or vacation home is considered a personal capital asset and is subject to the standard short or long-term capital gains tax rates depending on the owner's taxable income, filing status, and how long the property was owned. Calculating capital gains tax on the net profit from the sale of a rental property is more complicated, especially if the owner has been deducting depreciation, has any suspended tax losses, or has previously lived in the home as a primary or second home prior to becoming a rental property. The 1031 exchange is a tax-deferred exchange of real property held for investment or used in a trade or business for like-kind property. The 1031 exchange defers capital gain taxes and preserves equity. It offers a solution to the tax-locked property dilemma because the owner can exchange real estate for other real estate with little or no recognition of gain or triggering of cost recovery, depreciation, recapture. A 1031 exchange must comply with the following 5 basic rules. 1. Property must be held for investment or productive use in trade or business. 2. Property must be exchanged for like-kind property. 3. Replacement properties must be identified within 45 days after the relinquished property is transferred. 4. The exchange must be completed, replacement property received, by the earlier of 180 days or the tax return due date. 5. Proceeds from the sale must be held in escrow by a neutral third-party intermediary, then used to buy the new property. The investor or taxpayer may not control or have access to the funds in between those two events. An exchange transaction requires careful compliance with time limits, property qualifications, exchanged values, reporting, and documentation. The complexities of the exchange, and most exchanges are more complex than a simultaneous swap of equally valued properties, require a team of professional advisors, especially a professional qualified intermediary. The qualified intermediary cannot be the investor and cannot work for, be related to, married to, or an agent of the investor. It must be a neutral party, and must hold the relevant funds in an account that the investor cannot access. Professional advisors assure compliance with IRS regulations. The role of a real estate professional is to help the client make the best business decisions, identify exchangeable properties, assemble an interface with a team of experts, and see the transaction through to a successful outcome. Residential property received in an exchange. Although 1031 regulations do not allow tax-deferred exchange of a primary residence, a future residence may be acquired through an exchange transaction. The owner should consider establishing intent to hold the residence as property for investment or use in trade or business by renting it for 2 years before occupying it as a primary residence. If the owner does not want to rent to just anyone, a solution is renting the property to a family member at a fair market rate. A personal residence received in an exchange and converted to a primary residence must be owned for 5 years and owner-occupied for 2 years in order to qualify for tax treatment as a personal residence upon sale and exclude capital gains tax on $250,000 of gain, $500,000 for joint returns. Any depreciation deductions claimed during the time the property was held for business or investment must be recaptured at the time of sale. If the home is not suitable for personal occupancy, the owner could exchange the property for one that will be more suitable, rent the replacement property out for 2 years to establish intent and avoid disqualifying the exchange, and then move into it. After January 1, 2009, a second home converted to a primary residence is subject to capital gains tax for the period 90-day time limit on home acquisition debt. It might seem like a good strategy to start out with a home equity loan or cash purchase and then refinance at a later date with a regular mortgage. If you are aware that a buyer has this strategy in mind, make them aware of IRS provisions regarding a 90-day time limit on home acquisition debt when purchasing property and securing a mortgage against the principal for the first or second home. In order for the mortgage interest to be treated as deductible interest on home acquisition debt, the mortgage must be obtained within 90 days of the home purchase. The IRS regards home acquisition debt obtained more than 90 days after the home purchase as a home equity loan. Interest on a home equity loan secured by a primary home is not deductible for purchase of a second home. Buyers considering this strategy should consult with a tax expert to plan for maintaining mortgage interest deductibility.